on all of this, I'm joined by Stephen King. He's chief economist at HSBC. Thank you so much for coming in. Stephen, it was actually a quite historic moment. They're trying to be more transparent. Bernanke answered question. Did it make you feel any better? Do you have a clearer view now of what's going on in the US?
I think the big uncertainty still is really the pace of growth. We think that for the first quarter of this year, we're going to have an expansion of probably less than 2% at an annualized rate. And that kind of pace is just not really good enough. If you look at a standard recovery from a US recession, from a particularly deep US recession, you often get growth in the first year of between 5 and 7%. When you're trundling along at 2 or thereabouts, it's frankly not good enough. And that's one of the key reasons why Bernanke is talking about this consistent problem of a lack of inflation, at least core inflation, basically saying we've got growth at that sort of pace, low levels of activity, how can we possibly see core inflation rising? The catch, of course, is that although core inflation hasn't gone up in the US, headline inflation has been rising. That's largely because of increasing commodity prices. And there's a big question there, of course, as to whether the rises in commodity prices are a consequence of strong growth in China or whether they're a consequence of loose monetary conditions in the States.
But what is now clear is that we're not going to see a big jump in interest rates at all this year.
Absolutely not. I think it was very unlikely anyway that they'd be seeing a tightening of policy. I think what Bernanke's effectively done is try to say, well, the consensus on the committee is very much in favour of keeping rates unchanged. There are a few hawks there who may disagree with that, but the broad view that's coming through, the view from Bernanke himself, is let's keep rates as low as possible for as long as possible, on the basis this is the way to try to get the economy back to normal.
Without any extra stimulus?
Absolutely. But of course, the big question perhaps for later this year is, well, we've come to the end of QE2. What happens if the rise in commodity prices squeezes incomes, leads to a slump in consumer spending? We'll talk about, say, another double dip story coming through. Would you then begin to see a move towards more monetary stimulus later in the year? Not part of our forecast
what are you
currently,
expecting?
Well, I think it's going to be unchanged and no further stimulus currently. But the more the oil prices rise, the more likely it is that the US will stumble pretty significantly. And we know that if you have a doubling of oil prices within the space of a year or so, it's typically a very good lead indicator of another recession in the States.
And now we're also expecting GDP figures today. What's the likelihood of another downgrade?
I think the markets are already pretty much on board with the idea that the first quarter numbers themselves will be pretty soft. The consensus is about 2% or thereabouts. We're at 1.8. That is very, very soft by past standards. So I think from that point of view, the Federal Reserve's new forecast for this year, 3.1 to 3.3, take into account the weakness of the first quarter. The doubt perhaps is if we see a further increase in headline inflation without any increase in wages, it means people's real spending patterns are being squeezed. In those circumstances, you end up with further weakness of consumption later in the year. And if that happens, then of course you may see some downgrades later on. And
is there still a risk of this? We talk about these bond vigilantes being out there focusing on Europe. Will they eventually focus on US? And if they do, will it be this year?
Well, funny enough, I think it's not so much a bond market problem in the States, it's a dollar problem. Because if the Federal Reserve is committed to keeping low interest rates there for a very long period of time, it actually secures a relatively low level of yields across the yield curve, makes it easier for the government to borrow relatively easily in the US. But of course, if the Fed is keeping rates very, very low for a long period of time, it just makes the dollar less and less attractive. And we've seen, of course, the dollar falling on the foreign exchanges. And that trend, I think, will continue through the course of this year.
Stephen, how concerned are you about what we're seeing in Europe? Restructuring or not restructuring for Greece? Germans don't seem to actually back it, but there's no solution except doing a restructuring, is there?
Well, the problem with austerity is that it hasn't really delivered the prizes that people expected. The idea of austerity was that the countries who delivered austerity would end up with significantly lower long-term interest rates. It hasn't happened. What ended up instead is much higher long-term interest rates because markets basically believe you can't continue with the austerity and the political pain that comes with it. Yeah. So what's the alternative to austerity? Well, one possibility, of course, is some kind of restructuring. I think there's also a gradual shift, in countries like Germany and France to recognise that perhaps the private sector has to take some of the hit for this, for the very simple reason that when you have a problem with restructuring, it's not just a difficulty for the debtors, it's also a problem for the creditors to the extent that they were far too generous in their lending in the first place.
But if they do have to take a hit, and if the private sector does take a hit, what does it mean, well, just for the future of Europe? Are we going to see a lot of the banks fail? Is it bigger than we actually are anticipating?
Well, we'll have to wait and see. Obviously, one of the big risks of any kind of restructuring, if it were to happen, would be questions about the banking system, how stable it is, what's the risk of some kind of further interbank crisis. All those kinds of things would be a genuine concern. But at the same time, of course, the hope would be that the taxpayers got deep enough pockets to bail out any banks that could end up in trouble. And in those circumstances, you'd hope to get a more stable environment in the future.
But will it be actually more unstabilizing than Lehman Brothers was?
No, I don't think so. I think the policymakers have learned an awful lot from Lehman Brothers. They probably learned a lot more about how to deal with crises of this kind and are well aware of what some of the risks might be. So I think in these circumstances, the chance of seeing something quite as bad as that is pretty remote.
So what do you make of the figure we had yesterday from the UK? GDP pretty much in line with what economists were expecting. What does it leave the Bank of England?
Well, the problem really is that we had a 0.5% increase following a 0.5% decline in the previous quarter. So on a two-quarter basis, the economy is completely flat. It's stumbling along, not doing anything in terms of an expansion.
At least we're not in a recession.
Well, that's reasonably good news, I suppose, but the fact is that the UK economy has stagnated. It's not really responding to the low levels of interest rates in the past. Of course, what it does suggest is that the Bank of England's got a bit more room to play with, in the sense that despite all those pressures for raising interest rates because of higher inflation, if the economy remains this weak, the chances of inflationary pressures beginning to build, and inflation expectations rising, are probably quite low. So I think that actually helps the Doves argument on the MPC.
Stephen, thank you. Stephen King there from HSBC.